we doing? Probably going to do a bit of a shorter one tonight, just because it's already quite late by the time I started recording this video, but I have just finished looking at Go. I couldn't start the recording earlier, but we will go back through what I seen. Grocery Outlet Holding Corp. Came across it from here, Insider Buys. First one down on the list that I would have potentially been interested in. Not interested in pharmaceuticals or funds. Probably would have been interested in that, but didn't actually even look at the price, to be honest. Was it that it? No, SBSW. No, not interested in that really either. It's obviously gone up with the price of gold, isn't it? And then if you look at gold, what have we got on the metals? This run up is almost identical. Look, SBSW there. See. Anyway, yeah, I was looking at Go because I came across it on the Insider Buy-in. Straight off the bat, it's a no for me, but I will tell you what I saw. And I've caught up on my tracker because I got a bit behind on that, writing down the stuff about the businesses that I've looked at. Just trying to find it off screen a minute. Hang on. So you haven't got to watch loads of scrolling. You can just watch the screen doing nothing instead. So Go, Grocery Outlet Holding Company. There's a large portion of Insider Buy-in, some selling as well though, so I'm not sure this is legitimate buying because it's all around about the same time. Sometimes even though it's green, which does mean open market purchase, it isn't actually just the way the Open Insider interprets it, but nonetheless, on the face of it, looks like there's quite a lot of insider buy-in, so obviously that piques my interest quite a bit. This is the funds, other hedge funds and all that own it. Somebody owns 9%, somebody owns 6%. It's a portion of their portfolio, so that's the thing that really counts to me. It's all very well saying, oh yeah, like they're a 10% owner, but that can be people like BlackRock and Vanguard, and that could be like 0.1% of their portfolio, and that matters less to me because their overall returns are not so dependent on the size of this investment in this company. I like to see funds that I've got like this one, around 10% of their fund is in this company. You think, well, they've got some conviction in it then, and that sort of gives you another string to your bow, in that if you find something in it, you'll be like, yeah, there's somebody else who's also seeing some form of conviction in it. But it looks like fucking roadkill. Has looked like roadkill since IPO, really. Is it ever trading up here? I don't know, but for those of you who don't know, it's a deep budget retailer. Let's bring it up here. Extreme budget grocery retailer. Apparently typically sells 40 to 70% below conventional grocery prices, mainly for a network of small stores, and they basically closeouts. I think centralized purchasing team buys closeouts, overstocks, order cancellations, packaging and near expiry items, suppliers at deep discounts. So they will do traditional purchase of staples and all that as well. It's heavily California centric. It's 570 stores across 16 states, with 51% of them in California. Non-perishable goods, 63% of net sales. Perishable, 37%. I suppose from a closeout point of view, this sort of thing has probably got the best dates on it. So it's the sort of stuff that you would be able to purchase and have less there's like a need to be able to sell it fast. I looked at the balance sheet. I've brought up I've got a different one up in a minute. I had a look at the balance sheet. You'll get the gist of it from my notes anyway. 60 million in cash, 382 million in inventories, PP&E 743 million. Current assets total 497, so almost 498 million. 3 billion in total assets. 2.1 billion in total liabilities, a book value of around 900 million. Goodwill and intangibles was 710 million, so tangible book value is around 190 million. It's got a large operating leases in it. So when it comes to downside protection, it hasn't really got it, even though the tangible book value, the leases will be counted as tangible assets in it, but they're not, are they? Like if the company went bust, you're not going to get anything from those leases. So even though it's got a tangible book value, the downside protection is very limited. Income is not very good either. I mean, I say it's not very good. 4.6 billion, almost 4.7 billion in sales is nothing to be sniffed at. EBIT though was negative, but then that came from 140 million asset impairment, 149 million goodwill impairment. So that means that this 710 million here for your book value is essentially potentially more risky, considering they've had 2 impairments in the last 24 months, or 12 months. Yeah, I don't like that. I don't really like goodwill and intangible assets. Intangible assets depends on what it is, because some things like Coca-Cola, the brand name and all that's definitely worth something. I think it's Liberty Media that owns Formula One, so they've got a huge amount of intangible assets. Well, Formula One is worth something. There's no way that Formula One is not worth potentially billions, So there are, when I say I don't like intangible assets, it depends on what the business is. Something like this, I'm not impressed with intangible assets. So EBIT was negative because of these, and net income was negative because of these. So EBIT would have been, or net income, I think, this might be wrong, but around about 41 million without the impairments, because obviously they're one-time things. It's not great, right? Because obviously your income has gone down because of it, but there's not money that's been lost today. They spent that money previously, and GAAP accounting says you've got to take it out, so that's added back into free cash flow or into operating cash flow. So from an EBIT perspective, it was actually slightly better than last year. I think it was like 39 million last year. But interest expense is quite high. You can see that the market cap's just under 700 million, but enterprise value is 2.4 billion, which shows the level of debt that they've got. What I didn't like is the return on deployed capital. So that's this is Lee Lu's thing, but on my spreadsheet I actually used Joel Greenblatts return on capital, but they're very similar and they come out with very similar figures. So the return on deployed capital for Go is only about 5%. It's not great. It has been historically lower as well, and historically higher. So it's a bit all over the place. So the underlying engine of the business, the real unlevered earnings of the business, is not great, because they're only returning 5% on your deployed capital. So it wasn't something that I was overly impressed with. Simple free cash flow as well, negative 222 million in operating cash flow, minus 229 million in purchase of property, plant and equipment. So free cash flow was around about negative 7.5 million. I haven't gone any further with this, to be honest. I just said I haven't done any NPV, net present value analysis. So that'd be like discounting future cash flows, or doing like Joel Greenblatt's future multiples and all that sort of thing. I've not done it because I just don't think the underlying business was not just today but historically is not great. The return on capital is not great, so it's not the sort of business I'm really interested in, especially considering you've got essentially no downside protection when you take into account that a large portion of this is leases. So it's just not for me. I mean, it's not to say there's not value there, but I'm not going to bother looking any deeper, is what I'm saying, because it's just not something that I'm enamored with. And not only that, right, a large portion of the stuff is closeouts, but Joel Greenblatt spoke about in one of his Columbia lectures that you find on YouTube, there was a company that got people investing in his lecture he was talking about, and that was a closeout store. Well, the problem with closeouts is that what happens when you get to a point where you can no longer purchase closeout stuff, all of a sudden you're not getting stuff, significantly cheaper. So it's a business model that I believe generally doesn't necessarily peter out, but it ends up getting to a point where it can stop being a closeout because it grows so much that you just can't physically buy enough closeout stuff to continue it on that business model, which is what he was talking about in his lecture. So I'm not enamored with the business model. I'm not enamored with the balance sheet, and the earnings historically and the return on capital is just not something for me. So that was a no for me. I had just Comcast, but what I might do, we might look at Comcast quickly first. I did have someone asking me about a Coty video that I put up months ago now, and the price in the video was like $4 a share or something, and I'm pretty sure I said that I wasn't enamored in the company again, and now it's like 50% cheaper. And I think one of the video, someone commented today saying, how do you feel about this 7 months later? Well, the honest answer is I haven't looked, so I might look in a minute. I think I'll just quickly go through Comcast, and then I'll probably look at Coty again, just so I can, for one, answer the person's question, and two, to keep myself up on that one, because Coty was another one I think that the intangible assets would actually be worth something, if I remember rightly. So it'd be worth having a look at that one again. But I will have a quick look at Comcast. So a quick look at the balance sheet, because I'm pretty sure Comcast is not in my tracker here. Was it CMCSA? What's going on? CMCSA? No, not there. Is that the actual ticker, or is that a different? Comcast. Oh, it is CMCSA. Yeah, that's what I wondered. The A at the end suggested to me that there's potentially Class A and Class B shares. So, it is the main class. So we will look at it. Got it up here. I was just going to have a look at the balance sheet, see what we got. What I would do is I will fill out this as we go, but I'm now way out the way now. I need to be down here somewhere. Effectively, every company that I'm coming across, I'm writing notes on. So if it comes up again in the future, I can just look back and say, I've looked at this, I understood what this company is, I put some notes in, and we can go from there. Keith Gill said one of the biggest things is tracking the market, and just having a database of knowledge. ComScoring, was this the right one? Comcast ComScore. Am I on the right one? Have a look. CMCSA. Comcast Corp. So no, I was not on the right one. Now I am. Comcast Corp, right, okay. That would have been a mistake, wouldn't it? Doing the wrong fucking thing. Comcast Corp. Price today is $28.71. Yeah, I won't put that in yet because we haven't got there. Let's just see what any insiders are doing. CMCSA, nothing, no one's purchasing. That was quick. So no one's purchased anything, so straight off the bat, that's like not, I like to see that. I like to see buy-in. So the fact that there isn't, it's not ideal. CMCSA, see what funds are holding it. 32%. Interesting. Is there anyone on here that I potentially respect? No, but 32%. What's the share price done? I mean, they could have bought down here. I guess. When did they get in? Quarter first stone, Q3 2024. So, oh man, they paid more than this. That's a huge portion of their, considering they paid more, that's a huge portion of their portfolio. How far do we go? 5%. Pardon me, I just punched the microphone. So I've got like a new document now to help me look through businesses with speed. Because I'm going to say no to a lot. I will say no a lot. Most of my videos have said no to pretty much everything. Most of Bryce said you've got to be able to look at stuff as fast as you can. So I've put together like a little, I wouldn't say like a pointed plan on how to say no. So the first thing I need to do is have a base understanding of the company. So we get Grok up. Where's the history? So the first question I always ask is this, and all I've been doing is copying and pasting that, and just changing this data here. Comcast Corp. I have CMCSA. I have moved over from ChatGPT to Grok because I have found that Grok is. I feel like it's given from this point of information, this line of information. I feel like it gives better answers than what ChatGPT does. You got to wait a little bit longer for it to come through, which is maybe why it gives better answers. I don't know. Generally, it's served me better to. I'm just gonna drag this off the screen. I can fill it out down here as we go. Yeah, generally it's served me better than what ChatGPT has done recently. But this is the issue: is you've got to wait for it to source the information. One of the largest global media telecom companies, I thought it was Xfinity brand. Sky, do they own Sky? Do they in parts of Europe? Generate stable recurring subscription revenue. Okay. Do they own Sky? Comcast completed a tax-free spin-off. Okay. MSNBC, CNBC, all been spun off, have they? Okay, so all I do is just copy and paste this in. So my next thing, just understanding how the revenues break. 66% of it is connectivity, core cable business, residential broadband, Sky branded services. Okay, so yeah. So 81.3 billion there. So the rest is for this one here. Look. That is not going to, let's copy and paste that in a minute, because that's not going to go in very well. This. So broadband, wireless, video, cable, voice, advertising, Sky branded services, business services, okay, wholesale connectivity, internet, okay, yep. Content experience, 34% of revenues, media, cable licenses, NBC, Peacock. Okay, so subscription again, different type of subscription, film and television production, theme parks, here Universal Orlando and Hollywood today. Okay, so this is a big business. Geography, United States, 76% of the revenues. Right. Okay. So from this, for now, I feel like we've got a base understanding of what the business does, which is the way I'm working, and I'm explaining it to you at the moment, so it's a bit slower than how I would be doing it. So next thing I'm going to do is try and work out the engine of the business. So that's why I get a balance sheet up, because for me the balance sheet is the first place to start. Cash and equivalents, so what is that in millions? Is that millions? That's billions, and is it? They got 9.4 billion. Let's just check on here. Too many times. Financial balance sheet. Total assets. Let's just check. Current assets. Cash. All numbers in thousands. That is 9.4 billion, is it? Must be. In cash. Wow. Is it? Yeah. 272 billion in total assets. Is that right? GPT can tell us this. Just so it's getting late, my head's not working properly. I've been puked up on massively as well today by my little boy. The Comcast current PV. Let's just see what it comes up with. Billion, yeah, okay, 200 billion. Alright. That is right. My head is right in the right place. Cash, 9.4 billion. Well, it's almost 9.5 billion. You don't need to be. You just need to be in the ballpark for this. Inventory, it doesn't really have it, does it? It's not that sort of business. So PP&E, 65 billion. A lot of goodwill though in there. Yeah. What would you count this as PP&E? We're not going to do it for now. It's okay, it's just acquired rights, so no. It's just wondering if it would come under equipment, but wait, no. We're just going to go with this 65.7 billion. Current assets, 29.5 billion. Total assets, 272.6 billion. Liabilities, so we're just, this is to, hang on, goodwill, tangibles, because they're huge in this, like, other intangible assets. What have you got? A total of 84 billion goodwill and intangibles. Here, look, goodwill 61.5, and then other intangible assets. Oh, but that's franchise rights. It's going to be intangibles as well, isn't it? Let's see what goodwill and intangibles, 155 billion. Yes, they are adding that in as well, which makes sense. As soon as I seen it, I sort of thought, yeah. So off we got there then. They're really saying all that. Good, 155 billion. So let's see what we got. Goodwill 61, another 60 there, so 120, 140. I'm guessing they're probably counting this in as well. So yeah, alright, we'll say that. Goodwill and intangibles, not 84 billion. 55 billion. Current liabilities, 33.5. So that's the first portion of Lilu's return on deployed capital we can work out there. Long-term debt, where are we on that? Non-current portion of debt, 93 billion. Total liabilities, here we go. Not pushing the right button. Total liabilities, where are we? So it hasn't got it wrote down. We're going to have to work this out. Hang on. 33.5 plus 93 plus 27.8 plus 21. 175. 175.5. What have they got on here? 175.25, okay. Let's go 175.3. Right, so far, this is the stuff that I've filled out, so now we can work out our book value, total assets of 272.6 minus 175.3, 97.3 billion in book value. That is not what they have said, though, is it? They said 200, 110. Oh, it's enterprise value. I haven't done book value. I'll tell you what we'll do in a second. Shut that down. We'll drag it into the spreadsheet and get the data out. But for now, tangible book value, it's negative, isn't it? 97 billion minus 155. Minus 57.7 billion. Right, so the only thing now we need for return on deployed capital is EBIT. So if we go to the statement of income, revenue is 123.7 billion. EBIT, so operating income, 20.672 billion. Net income, 19.6 billion. And the interest expense, I just like to keep an eye on, it's only 4.4 billion, okay. Right, so return on deployed capital now. So current assets minus current liabilities, 29.5 minus 33.5 minus 4 minus 9.5 in cash minus 13.5 plus PP&E 65.7 billion. That's 52 billion. So we've now got 20 billion. So that's quite high. 20.7 divided by 52. About 40% return on deployed capital. So that's interesting. That's a high earner. Now we'll check whether or not I got my data correct, because we will pull it into my spreadsheet, which is down here on a different screen. Let's just pull it up here. CMCSA. I'm having a proper geek out on financial stuff tonight. I got Too Big to Fail on the TV in the background. It's a great film if you've not watched it. If you've seen The Big Short, watch Too Big to Fail. It's like the governmental side of the financial crisis. Right. I'll do that again, have I? Yeah. Right, let's just check I got that right. Income statement, balance sheet, cash flow statement, main metrics, capital 20%. So it's not as high as what I've got it. Okay. Have I got my book values and stuff right? Tangible book value minus 45. So they've got minus 57. 97.3 is correct. So the intangibles are different on my spreadsheet to what's there. They're not overly different, so I'm not concerned about that. We just leave it. But return on capital is still pretty good. Let's just go back to this. Make sure the data is correct. Where am I going? Cash flow. 33.6 billion in OCF. Purchase of PP&E is going to be capital expenditures there. Okay, 11.75 billion, so 33.6 minus 11.75. This is just quick, simple free cash flow, because when I do my simple free cash flow in my spreadsheet, I take away things like share-based compensation, stuff like that. So 33.6 minus 11.75, 21.85 in free cash. So what is the market cap and the enterprise value? Get a spreadsheet up. Market cap's 104 billion. 104.4 billion. Again, still not used to having the microphone in front of my face. I'm not savvy enough to. 205.3 billion enterprise value. Again, that's because I pressed the wrong button. No, I've got caps lock on. So 21.85 into 205, so it's 10 times ish. 205.3 divided by 21.85. Yeah, 9.4x EV, which isn't bad. This is just so I can have a quick look through, as opposed to having to pull it all into the spreadsheet. I just put this stuff in. Simple free cash flow to EV is 10 on here. What's historically higher? No downside protection though, that's the thing. If you use tangible book value as a proxy for downside protection, there is none effectively. You would lose your money. Let's just check it and see. It's difficult with this one though, because it's not a liquidation value thing. It would be a reproduction value. Just because the assets that they own are quite significant. Yeah. Let's just ask Grok, what do you believe an adequate reproduction value for Comcast would be? Just wondering, just intrigued to see what figure the AI will come up with. That's another thing, yeah, it's to do with the values to do with passing homes. I've done a company like this before. Just because people aren't connected doesn't mean that they can't be, so there's value in that. They may not be using your services, but they could use your services in an area, you know, so there's value in that. Is there anything in here that I really like though? Let's have a look. Oh, that's trying to figure that out. Gross margin slowly creeping up, look. COVID. SG&A margins creeping up as well though, sort of negates it. Simple free cash flow margins very consistent, look. 11, around the 11%, 11-10%. It's very consistent over the last 6 years. What was it before that? 11, 11, 10, 10, 11. Wow, so that's a consistent company. 11%, 123 billion revenues are quite consistent as well, at least in the last 4 years. Long-term debt, 93 billion. Interest coverage is 4, so that's really good. I don't think that it looks cheap though, does it? I don't think there's anything here to suggest that it looks cheap. Simple free cash flow, $5 a share. Trading 9x compared to EV. Oh, I don't know, it doesn't look cheap, does it? 10 years to get your money back is generally not something I'm interested in. I'm trying to be more Lilu, Monish Babrai, in that it takes, you should be looking for stuff that'll pay you back in 3 years, 5 years maybe. The market cap side of things, if you look purely at market cap, it would, but you cannot. That's basically assuming that the debt doesn't exist, and it does. You buy a company, you buy its debt. 10x. I don't think there's anything here to make me feel that it's anything other than probably reasonably fairly valued currently. I mean, the price is, it broke through recently here, but the technical analysis side of things is suggesting as well you're probably there you go, in a fair value region. Any news? Trading up. Concessions push speedy approval. Not seeing anything here to suggest that it's wildly undervalued. I'm just not. There's no insiders that are jumping out. Is anyone saying anything on Seeking Alpha? CMCSA remains hold. Someone said a buy in March. I prefer a Comcast over Verizon. Dividend. I'll tell you what, that's something I haven't looked at. The dividend. Has it got a dividend? 135. So I've got this figure from Roland Keating's videos. He said that people are willing to pay around about 20 times dividends. So at 135. $1.35 times 20. I think 1.35 times 20. 27. It's 28, see? So that's another thing suggesting you're around about fair value. 20 times dividends is 27. I don't really like, it's trading around book, isn't it? I don't like the tangible book. I don't think there's any downside protection there. You would sell the company though. People would want the assets for sure, wouldn't they? The ability to connect people. There's no way that people would not want this. The cash generation is reasonably stable. 10% revenues, look at that. That was very stable for a while. It's actually quite high compared to previous. Is now. So what's happened there? So your net income's gone up to 33 billion in net operating cash. Capital expenditures are down slightly. So that entire difference comes from that. That's 6 billion. Yeah. 6 billion and half a billion less there. 6.5 billion. What was the difference? About 3 billion. Yeah. I'm not seeing anything here. So I'm going to move on from Comcast. I'm just going to write down here. Not seeing anything currently to go deeper. Downside protection is potentially a problem due to negative tangible assets. Free cash flow capital very consistent, as is free cash flow margin. Historically trades around 10x EV and is currently there now. 20 times divs also gives current share price. Not seeing any real upside. Likely fairly valued. Right. Let's just see what the reproduction value they come back with. Comcast replacement value. Total assets 65. Where's the actual thing? We estimated 160 to 200 billion equity reproduction value. 44 to 45, $55 per share. This is above book value of equity of 97 billion. Way above it. Breakdown of components. Let's see what how they've come up with this then. I mean, you can just pause it. I'll just scroll down through and you can pause it. 67% of production value comes from the connectivity. Customer base, 50 million plus relationships across broadband. Sky International, subtotal, reproductions. Okay, content and experiences of theme parks. Yeah, they would definitely be worth something. Definitely. Okay, so from an asset point of view, yeah. But the cash flows are not, you know. Minus total liabilities of 99 billion of debt for taxes, non-current, 144, 155 billion. Okay, so that is, what's the book value? 97. I've got it as. Okay, interesting. I don't actually see anything here to potentially disagree with either. Interesting. Alright, should we move on to Coty? I've already got it in here. Yeah, I've already got it in here. As I said, it was about $4 a share when I did it last. Let's have a look. Coty. Okay, insider buy reasonably recently as well. $200,000. On the sort of level that I would be interested in looking at. Coty. Just so we are on the same page, mind, to the person that asked this question, I haven't got a clue what I'm doing. I'm literally a newbie investor that is vlogging my journey to hopefully becoming a successful investor. I have taught myself, I am on my own, so please don't take anything that I say as an educated opinion, because it is not. I am not financially educated. Like I said, I'm literally just vlogging my journey in the hope that maybe someone notices and then they want to network and all that, so I got people to bounce off, because I know nobody that is interested in this sort of thing. It's only me. So I do this on my own, sit in front of the computer on my own when I get spare time. I can't talk to anyone about this sort of thing because nobody I know is interested in it. So I'm basically vlogging my journey of trying to become a successful investor and hopefully networking with people or getting people to notice my analysis and help me on my way, help me teach me stuff. So please don't take anything I say as gospel, because I have no idea what I'm doing ultimately. But we will look back into Coty, because as you pointed out in the comment, it is 7 months later now. Thank you is the latest one. Balance sheet, what have we got? Total assets, it's 4 billion. And book value. Oh, but then goodwill and intangibles is, wipe that straight out, look. Upload media. It's the same question we did start with, because I can't remember who Coty owns. Is Coty the one that owns Ed Baker and stuff like that? I think Coty is the, yeah, Baker as well. Oh, Rimmel, that's right. Cover girl on Rimmel. Yeah, licensing deals. Oh, if the cash flow's improved. Like I said, this is where it becomes difficult, right? Because the intangible assets have a value. What you prescribe to that value is, what did I say last time? Jab hold. Ah, yeah, Jab Holdings. There we go. This is what I wrote on it last time. I've actually updated the way I write shit down. If you go back at the beginning and see what I was writing then compared to what I'm writing now is different. How I'm laying it out. Jab Holdings, yeah. So they're a big family that supports Coty and gives them money effectively when they need it. Backstop protection help boost bond prices to keep them tighter. What did I say then? 50% owned by Jab Beauty, 100% of their portfolio, and they have control of the company. So basically, this Jab Holdings has been one of the people that has helped refinance the debt, I believe. We've got all Rimmel, Max Factor, Sally Hansen, Gucci, Burberry. So this is licenses, so it's not owned. I don't know if they've still got any of these Tiffany, Hugo Boss. So these are big companies that they are allowed to produce stuff, beauty products, mostly fragrances, some cosmetic skincare for. Swarovski, 7.5 billion to acquire Procter & Gamble's beauty brands, instantly levered up the balance sheet and created a free financing cycle. Coty is still managing today. So what is that? 7.5 billion of debt. What are we at now? Long-term debt. Oh, 3 billion. That's come right down, look, since I last looked. Where's the 7.5? When it depends when they bought it. So the debt's come down. They are paying it off. What's there? Well, that's what I said then. Coty's never repaid major bond maturities entirely from free cash flow. Instead, it's constantly roll maturities forward, raise capital through asset sales. Oh, did they sell Weller? They were going to sell someone else, weren't they? I remember. It sold like 40% of something or something like that. 36 plus countries. That's right. Coty sold 6% of Weller to KKR for 4.3 billion and retained a 40% stake. They used money to pay down the debt, 2 billion in debt, although it hasn't been stated. They have shown willingness to sell in order to service debt. In their latest 10K, they own Weller is now worth 1 billion. Coty sold 6% of Weller, retaining 40%. Sold 9% of Weller to KKR affiliate, reducing its stake to 30.6, 4.7. So an additional 3.6. Coty stated they intend to sell all of their remaining stake in Weller, but no definitive time has been announced. So let's have a look. Have they sold Weller? Let's do it on here. Have Coty now sold Weller? Come on. Yes, Coty is now fully sold Weller. Coty sold its remaining 25.8% KKR for 750 million, completing its exit. Coty no longer owns Weller. So what did they do with those funds? What did they do? We could probably have to find out on the balance sheet, not balance sheet, cash flow statement and the balance sheet. What did they do with those funds? Let's have a look. See if we can figure it out for ourselves. So, proceeds from sale of investments, 750 billion. Repayments of revolving loans, 1.4. Repayments of long-term debt, 1.5. So they likely used that to pay off some debt, although they also took out 853 million from a revolving credit facility. Dividends. Right, operating activity 624 million. Capital expenditures of 524 million in all. What's the enterprise value? 5 billion. We simple free cash flow of around 361 million. 13x. Simple free cash flow to EV. Return on deployed capital is very low though compared to few years. Although simple free cash flow is flipped, look. What was there? So they definitely made less last year. What was the difference this year? Accounts payable, there you go. Accounts, they've bulked up 100 million, over 100 million. Look. By not paying their payables, we go on the working capital analysis. There, look at that. Fuck me, that's a jump. That's like cash flow manipulation, really. Not saying that because everyone does it, right? But that is a way where you could get caught out in thinking that the underlying is better than it is. They are taking 118 more days to pay off their payables, so the cash is staying on the books that much longer. When it comes around to the financial reporting, that cash is there because they haven't spent it yet. So yeah, taking longer as well. Look, 8 days longer. It's not huge. Like a week longer inventory staying on the shelf, a week longer. They're also collecting slower though. Receivables are higher compared to revenue, so suggesting that their day sales outstanding is 8 days higher. Then inventory staying 8 days longer as well, but then payables are 120 days, 118 days, 120 days longer. That is where your cash boosters come from. So, anything else? They paid a lot less for inventories as well. So are they running down inventories? No, they're not. Not really. That's not significant, is it? Like, what's that? 16 million in between. That's not significant. They're not running down inventories, but the operating cash flow has been boosted on by 100 million, purely by 100 million increase in payables. So it's not gone off the off the financial statement. Losses from equity investment as well, so they've got that as well. Depreciation. The net cash looks good as well then this year. Operating cash flow minus investing cash flow, yeah, significantly higher than what it was last year. Look, because of that 750 million income, I'm not seeing anything markedly different than last time, to be honest. Dividends a share is fuck all. I said you're trading. Simple free cash flow is boosted by the payables. So 100 million higher. So it'd be more in line with the last few years if it wasn't for those payables. It's the working capital side of it that's boosted the simple free cash flow as opposed to actual underlying business. So I'm currently not really seeing anything different. The debt coming down is a big thing. It is a big thing because the debt is a problem. What did I write last time? Well, it's not a problem because that jab fucking prop them up, but I said no downside protection last time. I still feel that way now, really, even though it's difficult. I feel like there's no downside protection, but there probably is. When they sold Weller for like $1 billion or whatever it was in total, more than $1 billion, didn't they, in total? And then they've got fucking, who've they got? Who do they own? CoverGirl, Rimmel, Max Factor. Their assets are worth more than the intangibles, and that have a value. So the asset, to say they got no downside protection isn't strictly true. They do, because they could just sell the brands. Debt's very high. There's been, even though it looks like there's been pardon me, even though it looks like there's been an increase in free cash flow, there hasn't. It's been a working capital thing that's caused that. So at the moment, I still don't see anything in this. Let's just ask, what do Coty's peers trade at on an EV to free cash flow? Oh, well, EV to free cash flow multiple. See what they come out with. At the moment, I'm not seeing anything different. Like I said, it looks like the business is better. It isn't. It's not saying it's worse either, because the debt's gone down, so technically it is better, but from a earnings perspective, it's not better. It just looks better because of the payables, which I've probably repeated several times now. Yeah, so look at that balance sheet again. But really, 3 billion in intangibles when they got, was it around about 2 billion in total for Weller? Just one. Those 3 billion in intangibles, you could probably take that at full value, to be honest. The goodwill it's not been wrote down though, is it? Has it historically been wrote down? Let's have a look a minute. Goodwill, where are we? Goodwill. Yeah, it's been significantly higher. What are they saying? 19 ELF, Estee Lauder. I was looking at Estee Lauder a long time ago. Around about the same time Michael Burry was in it. So they are around 20s. This is currently trading around 10. I mean, it's not enough for me to build a thesis on, but who owns Coty on here then? Jab Holdings, obviously, biggest. Yeah, Jab Beauty. Nobody else is really in it at all, see? Got a couple at 5%, no idea who they are. I don't even know how you pronounce that. Investment strategy, speculative, and entails substantial risk. There you go. So that's not somebody you should be necessarily relying on. Investment strategy, fundamentally driven investment strategy, focusing on companies in the US consumer retail sector. Long short. Michael Zimmerman, don't know, haven't heard of him. Who else do they own? Where's their holdings? There we go. That's it. Snap, ERPN, Coty, BNBL. See, that's in it. I still can't make up my mind on Bumble. Which means you shouldn't invest in it effectively, but yeah, okay, so for the person who asked about Coty, I don't really see that much has changed. Let's just see. So what is it they're trading? Coty's trading around 13x, so you're not too far off the grey on the Z double prime, which means that the Altman Z double prime score doesn't necessarily think the company's going to be around, but that Jab Holdings is going to keep it around, I would say. My opinion on it hasn't really changed, to be honest. It just hasn't. I mean, gross margin's still pretty good. Earnings have come down. Simple free cash flow margin, said that's slightly higher than it should be. Also, that was 3-year average, so I suppose it's slightly smoothed out. Tangible book value could be different. It's not trading below. Like, you fucked off the goodwill, so what would you have then? Tangible book value. So your tangible book value would literally be around about 0, which is not good for downside protection. Buy the company for $2, everything goes tits up, and you get nothing for it. As you don't lose money, you don't get into negatives, but yeah, my opinion's not really changed, to be honest. Yeah. All right. Let's just see how I finished off Coty last time. What did I say? $251 million. What's the interest? Oh yeah, what's the interest expense? There we go. This is another thing. I was obviously, 216 million in interest expense. Oof. Yes, this I remember now. This is what I hated. Look. So last year, TTM, 219 million in free cash flow. Bear in mind, this is 100 million higher than it should be purely because of working capital. It was negative, like negative after interest expense. Although it's difficult, right? Because interest expense is actually already in simple free cash flow. But it just shows the level of what you're going to get next year. Your simple free cash flow could be 200 million higher if it wasn't for the debt. Yeah, all right. I said I don't currently see anything different. I don't see anything that makes me think, yeah, this is worth more, worth less. The debt is just still huge, isn't it? It's still a huge thing. Yeah. Where is it going to go technically next? Oh. Jeepers. There's literally nothing but floor below it now. You've broke through. You broke through historical fucking resistance here. Look, is there a bankruptcy on the horizon? I don't know. It doesn't look good, does it? 5 new independent directors, securities class action, deterioration in income. It doesn't look good. There could be some big asset sales on the horizon. Their debt is the problem. It's a huge problem. 216 million in interest expense a year. The cost of debt isn't too bad if you do, what's it, interest expense divided, what have I done that? Interest expense divided by total long-term debt or something like that. -1 minus the tax rate. I can't remember. Total debt 3.6 billion. It's come down. Like, it has come down, significantly come down, but it's a fucking problem still. There's no other way to put it. It is a problem. 530 negative net income. Operating income's only 75 million. Return on capital's awful. Honestly, Jab's probably not gonna let it go bust, but it doesn't look good, does it? Don't just ignore these because this is wrong. They're still in there. That is wrong. All of this to ignore. It doesn't look good. I'm not saying they'll go bankrupt, but it doesn't look good. Coty. Buy. Hold. Buy. Same person again in March. Too much bad news pricing, initiating with a buy, oversold after capitulation, like sell off. Is the market so far is not agreeing? Is it? My opinion hasn't changed. Like, I just think if you buy, it's very, very speculative. They're gonna have to sell some assets on it to get rid of that debt, and then all of a sudden you could be 200 million higher. You're double your free cash flow if you could get rid of a significant portion of that debt. It wouldn't surprise me to see asset sales on the horizon again. Yeah. All right, well, I'm going to leave this video here because it's getting late. I want to go to bed. I hope that's answered your question to the person who commented asking about it. As I said, don't take anything I say seriously because I ain't got a fucking clue what I'm doing. I'm literally a self-taught bloke vlogging my journey as opposed to anything else. Never fucking invest on anything I say. It's the warning that I can very strongly give. Yeah. Anyway, thank you very much. Please like and subscribe, and I will see you on the next one. Cheers.